Thank you very much for joining us this afternoon. I'm very much delighted to be here. This is the fourth time that we have a present at Master Investor Show, which I really enjoy coming. So hopefully we'll see each other more in the next coming years. So what I've prepared today is something very different, I think. And it's very important to my industry, which is the active management industry. I would say we are dying a little bit. And the reason we're dying a little bit is because the rise of passive trackers have basically outperformed a lot of active managers. I mean, not including us. I mean, luckily that we have outperformed, but majority of my peers has underperformed the trackers. And if you think about this, over 20 years ago, of course, I mean, fund management has been around for years, and a lot of fund managers probably would have underperformed the passive or the market maybe 20 years ago. But 20 years ago, you cannot actually buy the market, right? The market that we are comparing ourselves against would be the MSCI World Index, which have about 1,500 stocks. So if you were to buy 1,500 stocks to rebalance yourself, the dealing cost is going to probably cost you a lot of money, which you couldn't do. But of course, in today's context, you can buy it, paying a lot cheaper fee than buying an active fund. And that had proven to be the case in the last at least maybe 10 years or so, that majority of my peers has underperformed. So basically, I prepared a couple of slides to showcase that the mentality or the playbook to outperform your peers versus a passive tracker are quite different. So it's just the way to think about this. And obviously, I mean, I would not imagine that a lot of you would be my peers. So this is more of an interesting industry topic that maybe you can quiz your managers if you do happen to speak to them today. So I'm not going to bore you with what we do. I mean, we have a stand downstairs, so come to find us if you want to learn more about what we do. But we manage just over £1 billion, running one single strategy, which is global long-only equity fund, investing into about 25 to 35 companies. So it's very high conviction, in-house research. We have a quality bias, which I will take you through some of the companies later. So come to find us. We want to learn more. This is just the way that how we run money. I'm not going to spend too much time on it now. But I want to take you to the very important things that I think is important for me, not only as the manager of the strategy, but at the same time, what's important for me as an investor. So this is something I put together this year. I'm biased. I have all my money invested into the Blue Whale Growth Fund, which I do not expect you to do the same. Because I pull the trigger, I run the fund, but I have a lot of conviction. But what is really important for me is throughout my investing journey, so let's say in the next 10, 20 years, what this chart is showing you is the time compounding impact, which everyone understands, right? Like I started off that journey back in September 17, that's when we first started, and this is just a very recent period. So everyone will understand compounding return is going to make you a lot of money. If you invested for 5 years versus 10 versus 15, 20 years, you will make more money, likely, if you invested for 20 years rather than 5. Everyone understood that. But I think what is missing slightly within my industry is no one tell you too much about the rates of the return they're compounding at. Because that's equally important. Everyone would talk to you, oh, I want to grow your capital, I want to grow your wealth, I want to make money. Of course, everyone is doing that. But how much money are you making? If you compound, so what I'm trying to show on this chart, if you compound your rate of return at 7%, which is, I think, similar maybe to the FTSE 100 over the last 10 years, versus maybe 10%, or versus maybe potentially 15%, the pots that you're going to get back in 5 to 10 years' time will be a lot more significant. So for me, being biased, because I have more of my money in this strategy, I just want to have the biggest pots possible. That's what I'm trying to do for myself and hopefully some of my investors who is part of this journey. But of course, it's not that easy, right? If I can deliver this line. So at the moment, just including the drawdown recently in the last few months, that we have analyzed us over just about 13% per annum. But a few months ago, we managed to analyze at 15% since we started. So now it's, at the moment, the fund is down a bit, so we're still at a 13% range. The tracker equivalent would be about probably 11%. Our average peer group would be below 10. So an average global fund would have given you below 10% over the last 7.5 years. But of course, this is not so easy, right? Like if I can deliver this line like that, I'm not speaking to you. I think you would just put your money in. This is more like a Madoff, a free lunch, like your capital just grow in a straight line. Of course, the market is more sophisticated than that. There's a lot of volatility. We're experiencing some of that now. But the outcome is you want to get the biggest pot possible after you've decided how much time you want to invest in money. I think minimum time would be 3 to 5 years. If you can invest for longer, I think potentially you make more money. So this is a very important chart for me, and this is what we're trying to do for our investors without talking about how we are doing it. I think anyone should be having the same kind of outcome. So then I want to go into what I'm going to talk to you today is a few things that is, I think, very relevant and very interesting to me as well as a fund manager, is very different when we are trying to outperform our peers versus the passive. So since we started back in September 17, we will be ranked in the top 1% of the best performing global equity funds. After a few hundred, there's a few hundred of us within the global equity domain, we're in the top 1%. So when I say outperforming peers, I think what you do is you look at a good starting point. Is like you find your peer group, they have done very well, you learn from them, you look at the portfolio, and then you see what you're missing. What you're missing means like whether you have better company than them, or whether they have better company than you, and then maybe you should do some work and copy their ideas. So if people, I think someone came to me to say earlier that 2 years ago he was in my conference in here, and then I was talking a lot on NVIDIA, which we still have. I'm sure we can touch on that later. And then he said to me he bought a lot of NVIDIA at the time. Of course, you would have made a lot of money, right? So you're leveraging on our expertise, our research, when you look at our top 10 holdings on our fact sheet. But what is interesting about the peers is very difficult to outperform the peers. It's a lot more difficult to do that versus the passive. Okay, I'm going to explain why. Because when you look at our top 10 holdings, which we got it on our fact sheet, that there's a lot of predictive value behind that. Predictive value means like the top 10 holdings or top 15 or the 25 companies that we have is a reflection of all the work, the judgment call, where we decided why we invest into these 25 companies out of the 1,500 companies in the MSCI World Index, right? So that is our choice, that's our selection. And we can invest in anything, but we decided that we only want to go into these 25 companies. So there's a lot of predictive value. And I would imagine it's the same thing for my peers. Everyone is trying to do the same thing. But of course, the market will be the ultimate judge, whether you're a better manager than another person. But I'm saying like there's a lot of learnings from each other, right? I want to learn from the better investors who might have been done well before, or maybe doing well now, or maybe going through down a bad patch. There's a lot of reflection of their ability. But I think the most important part, which is I put it down here, is everyone is a contrarian. We are a contrarian. But you cannot be a contrarian too far ahead of time as an investor. You need to pick the right time. So people have been saying NVIDIA has been a bubble over the last 2 years since I was here 2 years ago or 18 months ago. Yeah, it's still the third biggest company in the world today, right? So maybe it's not right. Maybe it's coming. Maybe it's a bubble now. But maybe you shouldn't have taken that view 2 years ago. Maybe you take the view now. Okay, that's not what we're saying. We still believe in NVIDIA and AI. So timing is very important. Everyone can do the work, research on companies. We have shown you what we have invested into. Someone else would have done the same. But is that now? Is that 3 years later? Is that 5 years later? If you tell me, so I share you with one interesting story. So I had a new analyst who joined us about 2 years ago. And then he asked me about, what is your investment time horizon at Blue Whale before I recommend my ideas? And I said to him, 3 years. So we have an average holding period of about 3 to 4 years. I said to him, 3 years. And then he recommended a few ideas. And then after 12 months, so after his first years, and then we sat down, we did an appraisal, a review. And then he said to me, and then he underperformed, basically. He underperformed for the first 12 months. And then we went through bits and pieces. And then he said to me, don't worry, Stephen, I still have 2 years to go. Right? 3 years time horizon, so one third of the journey, don't worry about that. All my companies are good and sound and all that stuff. I said to him, you got 6 months to fix it. Because the 3-year window comes with an 18-month probation period, just like anything else. I'm not going to sit here to have him with the ideas in this fund after 2.5 years and has underperformed, there's no sign of recovering, and say to me, something magical is going to happen in the last 6 months of that 3-year journey, and then suddenly everything recovers. That is not how we invest. I'm sure maybe there's some expert out there who can do that, but that's not how we invest, right? We do a lot of research. So hence, what I want to see is that you will never get the timing right. But I want to see a clear trajectory. So if you got the wrong time, I want to see that you're not overly early. So we have underperformers in the fund too. We don't get everything perfect. But I want to see by the time you get to 18 months, the company is back on trajectory. So then you have a good chance to recover not only the performance that you have not delivered in the first 18 months, but with the potential to outperform across the 3-year period. So that is the task that I have given to my team, and of course that would be the expectation I'm sharing with you, that you probably give me maybe 3 years, because I just feel like it's very difficult when we're running a strategy, then we're being a bit stubborn and refuse to acknowledge maybe the market's changed. So I think 3 years is quite a long time. If you underperform consecutively for 3 years, something is not right, which I come back onto. But this is an interesting slide. I don't think anyone would have talked about this yet, which I hope that I'm a pioneer in terms of this. But it's a very simple, like 101 basics. I think like once I've gone through this, you will understand like that should be quite easy to outperform the tracker or the passive. So what I've got here is what is the passive tracker compared to our active funds. So active funds continuously to form a differentiated view on a company. That you need to be right than wrong in time, right? So we took the view on NVIDIA before. We think it's going to become a lot bigger. It was a very differentiated view because a lot of people don't believe in it, and it materialized. So then we were right? That's how you do it. And if people haven't owned it, then you will have underperformed versus us. But what is passive tracker? So if you look at the iShares MSCI World Tracker, 1,500 stocks, it's just an algorithm that continually buy outperformers. Outperformance means that the market cap is going up the rank, and sell underperformers, which your market value become a smaller number in time, right? So you get a smaller weighting. And it does it on a daily basis. It rebalances on a daily basis, continuously. So if you look at the S&P 500 index, you were saying, oh, yeah, it's done so well over the last, 50 years. And then it goes through all this dip. But the companies are different. It's not the same company like 20 years ago that are the biggest company in the S&P than today. So there's a magical formula behind it. It's basically buy winners, sell losers continuously. So that's what the passive is, right? There's no predictive value behind it, very importantly. If you look at the top 10 holdings of, let's say, S&P or MSCI World Tracker, it doesn't tell you anything. It's a reflection of all these companies have achieved what they have achieved, and they got to where they are, and then you put your money into them based on the allocation of the market weighting of their value, and that is it. There's no predictive. There's no learning, basically. I'm saying, like, I'm not going to look at the index and say, what is the learning behind that? Why is Apple the biggest company in the world? There's no learning. But if someone else that I respect have backed Apple being in the top 10, then maybe I want to ask a question, oh, what are you seeing that I'm not seeing? The passive doesn't do that, right? That's what passive means. So what you do to outperform is actually quite simple to us, actually, is that you want to, 3 things that you do. Firstly, you invest into companies that are rising up the rank. Right? The index is just a composition of reflection of market value. You buy companies that are rising up the rank. So if I give you back, people would probably be bored too much with NVIDIA already. NVIDIA's revenue 3 years ago in 2022, having been around for over 20 years, run by the same guy, Jensen Huang, was generating $30 billion revenue in 2022. After 20 years of products, GPU success and all that, $30 billion. This year, in 2025, 3 years later, is going to generate over $200 billion worth of revenue. That's an incremental real number. I'm talking about billions, not millions here. $170 billion of incremental spending with NVIDIA today than 3 years ago. That's bigger than our entire NHS budget. This is serious money, right? So what do you think the share price is going to do? What do you think the market value of NVIDIA is going to do in the index? It's going to go up. So the beauty of an active manager, which the passive can't do, is you can invest ahead of the journey. You pick it when it was, we invested into NVIDIA when it was a $500 billion company, and now it's a $3 trillion company. The market can't do that. The market always a reflection of the previous success. But you can invest ahead, right? So that's what you do. Secondly, easy, you should avoid companies that is going down the rank. Right? If there's something have changed, whether it's Trump, new policies, COVID, or maybe disruption to your business model, or maybe some cyclical issues, you're going to be facing headwind in your company, right? Estee Lauder, Nike, some others, stock market darlings for a long time. But the world have shifted. So if you look at the market value now or the weighting in the index, they have fallen down the rank. So you try to avoid most of these companies. Of course, we do have a few, but not enough to, not as many outperformers that we have, which are the company going up the rank. The last thing, this is surely the most easiest thing everyone can do, is to take a view on the biggest company in the world, which is the top 10 or top 15, to decide, to make a decision why you're not investing into those companies. Is it because you have something better or not? Because if the biggest company in the world continue to do very well, and you don't have them, or you don't have something similar in the performance capacity, you would underperform. That's not difficult. I mean, just do some work. I mean, get some analysts to go through NVIDIA, Apple, Amazon, Microsoft. Like for us, the interesting story was I see a lot of complaint last year because only 15% last year in my sector, a few hundred of global equity manager, 15% of us have outperformed the MSCI World Tracker. We were one of the 15%, but it's a very small number. It's not even 50%. It should be 50%, but 15%. And I read a lot of commentary from some of the managers who underperformed to say that, oh yeah, because we were underweight the big tech. We didn't have the big tech, or we didn't have NVIDIA, and so forth, right? But we were underweight the Max 7 too. So we are selling out Microsoft now. We don't own Apple. We don't own Alphabet, Amazon. But we had the best stock, which is called NVIDIA. At the same time, we have something even better. We have Broadcom and TSMC last year. So we were underweight Max 7. We took a deliberate view on this. We don't like a lot of these companies because they're spending too much money in AI. We like to invest in the companies on the receiving end. So we were underweight the Max 7, but we outperformed. So surely that's what you do, because it's a big call. Now we're selling out of Microsoft. We have a lot of concern on the return on invested capital profile, going forward, the margin, etc. But Microsoft will be around. But what we're saying is the likelihood of Microsoft to give you a significant higher return than the market, which is what we're trying to outperform, is a lot lower. And we are confident for now that we have something better. I think that's what an active manager needs to do, is to ask the question why you're not owning them. Do you believe that you have something better? And there's no excuses of saying, oh, I have too much in certain regions or certain sectors and they're not tech and you underperform. Maybe then you should be charging a passive fee. We are charging an active fee, right? I'm trying to justify to you why you might be paying us to do it. Otherwise, you might as well buy a tracker. I think that's very important. And this is the three things you just need to do. Buy companies that are rising up the rank, avoid companies coming down the rank, and take a view why you're not owning the biggest company in the world, right? The last slide, not actually the last one, but the last one I want to share with you is like, what are we trying to do for you? Like why you might be paying us an active fee, which I wouldn't say a lot, just about 1%, less than 1% a year. I think the two things that we do. One is we try to navigate a different macro environment with more outperformers and underperformers. Of course, we do have our bias. We like quality companies. We like companies that can grow. I'm not going into the details yet, but we like outperformance. Outperformance means that you can make more money than the market equivalent, the market index, for example. And people forget, I think some of my peers forget, any company operates in the real world. Means the real world continues to evolve with different policies, macro backdrop, and now we have Trump. And of course, on the back of Trump, it does create some opportunity too. So this is very unusual. I don't think any of my peers would have done it. Like we have one European defense company called Leonardo. So it's an Italian defense company. So we had that for about 15 months. But if you look at the year-to-date return of Leonardo, it's gone up like 70%. That is a serious return for a boring European defense company. Like, why is that? Very simply, not on the back of Ukraine crisis, but purely, I would say, on the back of Trump being elected. On the back of the conversation between Zelensky and Trump over a month ago. And literally, Trump was saying, Europe, you sort yourself out. I'm going to pull out from NATO. Russia is not my enemy. I don't care about Russia. We're friends. My only enemy is China. So suddenly, European Union, for the last 50 years, never happened before, decided to amend the fiscal discipline to make European defense the highest priority than anything else that they have done before. Who is paying for that? Taxpayers. Right? The European bond yield has gone up, and taxpayers are going to pay for that. So that if you can invest into this company that is actually benefiting from some of the macro uncertainties, that you can make some money from it. And the other thing, which I think is a live example where we are today, and if you have followed the fund a bit longer, that you will probably have seen something similar back in 2022, is I think is the ability for a good active manager to fix underperformance. Everyone underperform just because that's how the market, the nature of the market, that's what active means. You will be doing something different to the passive. But there's three things that you do. I don't know what you do, but there's three things you could do. Either you do nothing. At the moment, we're doing nothing. But going back to 2022, we did three things, which are these three things. We did nothing with a few companies like NVIDIA or Microsoft. We bought more shares of NVIDIA and Microsoft back in 2022. We exited some holdings because we recognized it was a new regime of geopolitical uncertainties, interest rate going to stay higher for longer on the back of inflation being sticky. At the same time, oil price would remain at a high level. Consumer discretionary spending, started from 2022, would remain under pressure for much longer. That is a new world compared to the 10 years running the pandemic. So we exited certain companies that we don't think is going to do that well in this environment. Thirdly, you introduce new ideas. AI was new to us. We didn't have AI 7 years ago. So we did a combination of three things, and then we recover. That's what you do, right? That's why you're still paying us a fee. It's like you underperform, you do well, most of the time you underperform, you fix it. So we're trying to do this continuously. I think if you follow the fund recently, I mean, we have given some of our return back. So we're fixing it, but we have adopted an approach of doing nothing. We're not concerned. We're very happy with what we have.